So over the weekend, Fairleigh Dickinson University, a 16 seed, beat the number one seed Purdue in the NCAA tournament, which I think was the first time a 16's ever done that, and is viewed as the greatest upset in the NCAA tournament history so far, which I'm not sure how that beats the Texas team that won the first time, but we'll come back to that. But we also had the Fed, the Treasury, and the FDIC considering guaranteeing all insurance, all uninsured deposits in the U.S. You had the Credit Suisse UBS merger with a controversial bondholder wipeout. And I think for the last several years, we've had March with the VIX topping 30 in each of those years. So every time around this year, we keep popping up to some dislocation in the markets and in the global economy. And today, this year is no different than the past. But I want to talk about a repeat topic for me, which is Fed tightening and crises. We didn't know when it was going to happen, but it looks like we're in a couple right now. I want to touch on the Fed's financial stability report, which they did last fall. They do it twice a year. We'll touch on some of the findings from that, and interesting to see what they wrote and what actually happened. And then talk about what's different in the economy today versus '08, because we naturally try and go back and make comparisons, and there are some significant differences between the time periods. So let's jump right in. So a year ago on March 16th, the Fed started tightening and announced their rate hikes. A year and a date to that period, Silicon Valley Bank went under, and then Credit Suisse's problems started appearing much earlier, but all came to a head. Last week, we saw Treasuries drop 80 basis points. They've rebounded quite a bit since then. WTI dropped $10 in a week. The affiliate and a lot of the indices said we're showing recessionary readings. Small businesses are saying the same thing. But inflation expectations have come down quite a bit. And now central banks are scrambling to deal with the confidence in the system, because we have a global financial system that's built on trust, and that trust is certainly shaken by the events of the last couple of weeks. So let's take a look at why some of that's happened and where it is. And I think it really comes down to we've had the most unusual monetary and fiscal policy initiatives in history for the last 15 years. And when you look at this chart and relate it back to Silicon Valley Bank, there's a couple things that I think are worth noting. For most of the period from 2010 right up into 2018, we were really in a very low net interest margin environment, but banks were comfortable because they were worried about the risks of the reversal of policy, because they're all waiting for the inflation that was going to come from quantitative easing. And then you fast forward to 18, 19, the banks have been running for 5, 6, 7, 8 years with no net interest margins to speak of, and they're starting to get pressure. When are they going to see those returns? So they start stretching, and what helps them stretch out their risk is in 19, the bank regulations eased and allowed them to switch some of their risks. So Silicon Valley did what a lot of people did. They lengthened their maturities, and we're not anticipating what came in 22, which is really one of the sharpest rate rises and steepest in speed and magnitude that we've seen in history. And most of the risk models would not have had that in. So I think there's kind of a perfect storm of a series of events that led us here, but there were also serious flaws in how they were managing their risk. And I think this is classic complacency. Gets to the end of a cycle, you think it's going to keep going on when you know it shouldn't, and then we start taking greater risks than we should. And I think that's what's coming out right now is the risks of a zero interest rate environment when you're not in zero interest rate environments anymore have come to roost. So we've had this in the past, and I've shown this slide a lot over the last year. And there's a great quote from an older investor named Rudy Dornbush, which says, the crisis takes much longer time in coming than you think, and that it happens much faster than you would have thought. And if you think about Silicon Valley, you think about Credit Suisse, it's not like they weren't called. In Silicon Valley's case, JP Morgan wrote about this in the fall. in Credit Suisse case. This has been going on for a couple of years. There's no real surprises here. What is a surprise is that we forget that this happens time and time again. And what you're seeing here is the blue line throughout is the 10-year minus the minus Fed funds rate. The pink lines are periods of tightening, and the blue lines are periods of easing. And we've seen this happen over and over again. It's like a shampoo bottle directions, rinse and repeat, rinse and repeat. And that's what we keep doing here. And we should know that it's coming. We just don't want to remember. So this is one of the lessons we should take away, is crises always happen, and they usually happen after the Fed starts tightening. But the other thing to take away is that in hindsight, the problems are almost always obvious. And this is a chart showing insured deposits in the US and uninsured deposits. So we're sitting at 7.4 trillion in insured deposits, and we moved to 10.5 trillion in uninsured deposits. Now, the banking system works on trust, and we've always been levered, but it's the amount of leverage that the banks have taken on. And in 2008, we got way above our skis and got too levered. They brought it back. But they then counted on the good nature of the regulators to bail them out. And I think one of the big messages coming out of the Credit Suisse deal is that bailouts are not likely to be the order of magnitude going forward. We're going to have to be left to deal with real losses. Both bondholders and equity holders are going to be have to expect that there'll be real losses coming their way when they take on risks, which is fascinating. There was a bondholder for Credit Suisse for their CoCo bonds being interviewed, and he was complaining that the equity holders weren't wiped out. And he was asked, well, if they're wiped out, are you okay? And he's like, oh yeah, then it's fine. Well, no, it's not fine. Everyone lost their money in that, but it's legal, at least. I think that's one of the issues that we're going to be facing. So when you look at these problems and you look at them going backwards, and you see that back in 13 and 14, we started to cross over to uninsured deposits being greater than insured deposits by a wide margin. And you think about that $10.5 trillion, and the US is basically a $26 trillion economy. It's massive. And we're going to insure all those with what? We're going to back it with paper and back it with confidence, hopefully. So I want to switch gears and just say, when it comes to a crisis, they'll keep repeating. At the end of a long expansion, you should start getting more conservative, not more risky, and we go the opposite way because we think it's going to continue. So the Fed does twice a year, they release a financial stability report. And in the fall, this came out in November, and they looked at the top risks that were out there. What's interesting about this versus the May report is Russia was number one in the May report, and persistent inflation and monetary tightening became number one in the fall report. But more interesting than that is the third item, market liquidity strains and volatility, was not on the list in May. So that wasn't even a consideration for the top risks in the system at that time. And it was over the next 12 to 18 months. So it wasn't like what's next week. This is a pretty big issue. And I think to Bill Deukler's credit and Andrew Rendak, they've actually highlighted the issues in the repo market as part of the signs of those strains developing. We just never saw it was going to play out. But this is an interesting look at it. But the Fed's going to get a lot of criticism in there, and some of it's justified, some of it may not be. But in their fall report, they looked at 4 areas of risk: asset valuations, borrowing, leverage in the system, and the risks to the system. For the most part, they got a lot of these points right, but they were either overlooked some or ignored some. And the yellows are things that they should have acted on a little bit more seriously when Treasury market liquidity got below its norms. I'll show you a chart on that in a minute. But the leverage at non-bank financials firms grew dramatically since the financial crisis. And we have all this leverage in the system that's really not fully accounted for by the system. And that is a huge risk that's almost unknown. So I think that's one of the things that we have to keep an eye on. What they really got wrong was they said that funding risks at domestic banks remain low. I think they might have been a little backward looking in that. And then they said structural vulnerabilities exist in other sectors that engage in liquidity transactions. I think that was partially reflection of the private credit issues, but it was also partially reflection of the decline in crypto assets at that time, because they have to factor in those asset moves, and crypto lost about $1 trillion around that period of time. They had the big declines. So the Fed saw a lot of the stuff. They didn't see it clearly and they didn't act on it all. But when they do this report, it's actually interesting to read. I think they're going to get a lot of criticism. I think a lot of it goes to the FDIC, who was supposed to be regulating and overseeing a lot of the areas of the banks with the Fed, but a lot of blame to go around. This is a chart that just shows the changes in liquidity over the last 3 years. And what's interesting is in the Treasury market, which is the most liquid market in the world, you can see the thin dark line on the bottom is the 5-year scale. And it's really, Treasury depth is defined as the average of the 3 bid and ask quotes sizes for on-the-run Treasuries. That's what we're looking at here. And you can see since around the time the Fed announced they were increasing rates in March of last year, you can see that it's really flatlined. But what you also see is that the fear started back in January. So people knew it was coming, that the conditions were tightening, and didn't really react to it till too late. So that's really, the Fed's going to be put through the ringer. I don't think it's all on them. Some of it goes back to the past administration, some of it goes back to the bank regulators, some of it goes back to bank managements, and some of it goes back to just the greed and the short-termism that exists in the market today. When you're late in a cycle, you don't pile on to higher risk, you pull back risk. And in our firm, we would not lengthen maturities, even though rates were going up, because we knew the risk in our fixed income portfolio wasn't justified by squeezing out extra return. And I think one of the lessons from this crisis is one we've been taught over and over again is every time you stretch for yield, bad things happen. And really, that's what was going on in the bank portfolios. They needed the net interest margin. They were getting massive deposits in, and they needed to do better, and that's really where we ended up. So switching gears to what's different today versus '08, I think it's considerable, and we tend not to think that way, but it is a very different setup. In '08, we were worried about going into a deflationary spiral and a Great Depression again. Today, we're in a more inflation-prone environment. You're seeing that the Fed's fight is really about inflation and financial stability right now, not about deflation, although that could come back and reverse pretty quickly. The other difference is debt has really grown dramatically since the crisis. We were about $207 billion global debt around the financial crisis. We're now approaching 207 trillion. We're now approaching 300 trillion in debt. So very different setup there. The interest rates were at near zero and slightly above, but dropped to zero very quickly and then went negative. Now we're moving rates up in a very different issue. And we're in what I believe is a more permanently higher interest rate and pricing structure for the global economy. Costs are going to be higher. The other thing is China was driving growth back then. They were able to do massive stimulus and get it going. They're not in the same financial position to do that. And then with the divisiveness that's going on with domestic and international relations, it's going to be harder to get coordinated actions, which we used to, that were really the key to, I think, solving the '08 crisis was the coordination that existed. And that's going to be much more difficult today. And then we've talked about this in the past, but policymakers don't have the resources. You know, the Fed balance sheet at the time of the financial crisis was $875 billion. We got as high as 9.1 trillion. We're back down to, we got as low as 8.5. And I think with what's gone on over the last week or so, with some of the changes that the Fed's made, I think they're have an effect of added a couple $100 billion to the balance sheet again. And so we're moving back up in that area. So very different. They don't have the same levers. But I think the biggest difference may be this reindustrialization that's going on around the global economy and where how capital is going to shift and where the alignments of economic interests are going to be. So I think we're in a very different boat today than we were in '08. I think you have to think very differently about it. For us, this is about investing in the real economy, not the paper economy. that the governments are telling you that they need to improve productivity. They're worried about each country's worried about their own resources, their own technology capabilities, their preservation against national security from others. And that means we're going to be bringing stuff closer to home, aligning with like-minded nations, and that creates a lot of inflationary pressures that are going to make it much harder to bail the economy out. And I'll add to that, the other big thing that we spend a lot of time talking about here is the clean energy transition is inflationary, and it's going to remain that way. And that pressure is really putting the central banks in a tough spot. So I think we're going to hear from Powell this week and from others as we move forward is that they're going to say that they have to continue the fight on inflation, but they have tools to deal with the financial stability as they're doing right now. So whether they pause or do 25 basis points doesn't really matter. What matters more is what they say about what comes next. And you've heard on these calls, I've said the market won't find firmer footing until it believes that the Fed stop raising rates. I think we're getting close to that point. But the other thing we're going to have to listen to now is very much what are they doing with QT? Because quantitative tightening is an experiment that has never been done before, certainly not on the magnitude of what we're dealing with. And I think we're going to find that the conditions were much tighter in certain areas than people thought with the easy money because of quantitative tightening, and that we're going to react to that. I think this means the economy is going to slow further. Lending standards are going to tighten, which means consumers are going to pull back. The haves and have-nots issue is going to continue to grow. But really importantly, the consumer is not going to be the driver for U.S. growth as they are typically. And that means you follow the money for the governments and corporations and what they're spending on. And that is real economy stuff. That's bringing manufacturing back to the U.S. It's creating these fabs for the chip industry. It's rethinking your climate change and energy transition goals. It's the real stuff that makes money that you can value in a much cleaner way. I think that's what's going to drive the economy forward. What we're focused on at ARS and have been for a while is those areas. But I think corporate earnings are going to be challenged because a lot of the people who raise prices are going to find prices didn't stick, and they're going to be stuck with a higher cost base with now declining earnings, and that's always a tough spot. And the other message of this whole crisis, and we've talked about this in the past, and particularly as it relates to the lack of liquidity in individual portfolios because of the dramatic shift to the private markets, is liquidity does not matter until it does. And then it matters a great deal. And we're finding that out right now. And a lot of the banks are sitting there realizing that their worries are around liquidity. So in our view, this is it's going to be a stock pickers market that people like to say all the time, but this is really a narrow market set of opportunities. I think it does have some significant implications for where you're putting your money and what you might want, shifts you want to make in your portfolio. So I think the survey that's being done and being requested right now is going to be really interesting to see what shifts people are contemplating over the coming period. For us, this is more of the same. It's you want to invest in the clean energy transition, you want to invest in productivity, the tech moves, you want to invest in the reshoring opportunities and the reindustrialization that's going on around the world, and you want to avoid the paper assets that are going to be under pressure for some time. So Mark, I'll stop there and we can open up for discussion.
Thank you again, Stephen. Questions, comments?
Stephen, I can't resist mentioning the Hemingway quote from The Sun Also Rises. How did you go bankrupt? Slowly and then suddenly?
Yeah.
Add that to the bottom of your slide, I think.
Yeah, thank you.
Yeah.
I did want to mention, though, I think there's something interesting coming in the oil space. We wouldn't be surprised if after the Fed meeting that there's an OPEC announcement on production cuts that pushes the prices up a little bit because they can't be happy with the price levels that we're at right now. So in our view, it's not written in, but that would not be a surprising development. Chris, I'd like your thoughts on that if you're. I think you're on mute.
Still on mute.
I give you a maybe on that one, Stephen. Yeah. I don't know. I will say that I think that you're seeing a direct effect of tightening financial conditions on the price of oil right now, and that a lot of the banks that are financing, have historically financed traders, are pulling back a little bit, and that's put more cargoes for sale right now than would ordinarily be the case. So you have a short-term effect on the tightening here, as well as the sort of longer-term effect, which is just fear, if you like.
The other thing we have is the strategic reserve. I don't believe has started to be refilled yet, has it?
No,
And so I think you'll see some increased demand from the lower prices coming as well. Mark, you want to go to next? I didn't see who was up first. Andrew,
I'm going to go ahead.
Andrew, I think had a comment on the energy.
Go ahead, Andrew.
Yeah, Stephen, Henry here, simple one. So overnight, I think I saw something, the Fed is looking into potentially guaranteeing all deposits. So instead of the 250K, now looking to potentially guaranteeing, once again, it's a study, right? Whatever that is. Do you think if that goes through, it might potentially prevent bank runs? What are your thoughts? Thank you.
I think it's tough math. So in theory, it should prevent bank runs, but I'm not sure the math will do that. I think they'll probably put something on a temporary basis only to try and get confidence up and trust back in the system. But I don't think they will go for a full guarantee, because you'd almost have to nationalize the banks at that point. So I don't think that they're going to do that. I do think this creates a significant problem, though. There's a trust problem in the world right now with the financial system, and that's actually, I think, part of the reason why crypto has moved up is that the argument against crypto goes away when a lot of the system is not supporting what it's supposed to do. The trust is violated. We did want to get Andrew because he was going to make a comment on energy, I believe.
Go ahead, Andrew.
Yeah, actually, it was a question, Stephen. I just, threw the energy thing back out on the chat. It's the interest rate rise has been very sudden, as you pointed out. It only started a year ago. And you mentioned impacts on earnings, and I assume that's due to a margin squeeze of sort. Correct me if I'm wrong.
Yep.
But have you been able to see in earnings a separation between companies that are directly impacted by their cost of capital being raised, as opposed to ones that don't have that sort of impact, and thereby not really having their earnings compromised due to higher rates?
I think you're saying in small caps, obviously there's a lot of vulnerability being exposed there. But we're seeing it in the public markets in the larger cap companies, but particularly in some of the areas where they were relying on the capital markets to finance very aggressively certain businesses like infrastructure businesses and others that we're supporting. So that's an area we've looked at. We've gone through our portfolio to see where we think our increased exposures are from this switch, and that's part of the game you have to play right now. Fortunately, we had very little bank exposure. I think we own JP Morgan is the only bank we own in one strategy. So our exposures were minimal there, mainly because we have a hard time figuring out assets, liabilities, and banks.
Do you have any banks that you like right now, Stephen? Because the whole space is down. There's got to be something out there worth buying right now.
There's always something worth buying. Just for us, there's other things I'd rather buy in this environment.
So, Michael, Cameron?
Going back to energy, I was just going to comment that with higher interest rates and more difficulty getting funding, activity in the Utica has been down, but also with the low natural gas prices, and most of the window in the Utica is natural gas. there's additional slowing. So it's interesting. And because we own a farm in the Utica, I watch how many white pickup trucks are in the hotel parking lots and how many of the fracking trailers are sitting in the lots in the area, things like that. So I think that this is really low. People are not factoring in potential volatility, whether from weather or an expansion of the war in Ukraine, things like that. But I'm also nervous about taking a position because I already have enough exposure just from our leases.
That's actually I think that's a great question that point that you're raising is everyone has to look at what exposures they have right now. Do they want to keep them or not? And it's easy to get complacent, but I think this is the time you really need to do a hard relook at the portfolios. Was up Duncan or something?
Duncan's up, yeah.
I was just wondering, that chart you put up there on the growth of the non-insured deposits, I mean, that is like the most startling chart I think I've ever seen in my life. I mean, where did all that money come from? Is that all the stimulus money that went in there, or the
ironically,
VC money that got raised? I mean,
some of it came out of the money. Some of it came out of the money market crisis when they broke the buck in 2008. And then they went to the banks, and the banks changed the guarantee levels from 100,000 to 250, and then that's where some of that change came from.
Okay.
But then
So people did.
but there's also
people did.
Mainly that expansion in deposits and the reserve expansion that goes with it, that's the government spending. That's the COVID stimulus.
there is that as well. Yeah.
So, okay, so how does this get, I mean, basically banks are intermediaries, right? I put my deposit in the bank takes my money and he buys, if I don't buy money market securities or T-bills directly, and I give it to the bank's just going to do that.
Yes.
Right? I mean,
Although the bank-
or I guess the problem is Silicon Valley Bank decided to buy, 10-year, long dated mortgages. But in theory, or the bank, the deposit money either stays at a bank and the bank buys the short dated paper, or people just buy it directly through a mutual fund. I mean, am I missing anything here? I mean, they buy Bitcoin. I mean, where's the money go? It's got to go somewhere.
I'm trying to think. They're all buying similar things, but what the banks can do to hold them in theory, because they're hold to maturity, allows them to deal with the time issue differently than an individual would. So I think that's part of the game.
Okay.
But then you have to match your assets and liabilities well and get the curve right, and they didn't.
Yeah, well, not everybody, right? I mean,
Yeah.
I actually went through a community bank balance sheet this week, went through their annual report, right? And, for instance, an unnamed bank, if anybody wants to talk offline, I'll talk about it. But, they've got $2.5 billion of unrealized losses on hold to maturity securities. But if you go look at the other side of their balance sheet, they've got like $7 billion of medium-term notes, fixed rate medium-term notes, and that sort of thing. Some of it as long as 10 years, and those things will be trading at big discounts. I think I brought this up last week, right? And what's a little surprising to me that was done during the financial crisis, it's not happening here, is the regulators found a way to highlight the fact that yes, some of the assets are down in price, but by the same token, all the liabilities are down in price. And it's a mismatched, imperfect spread game that the banks play, but most of the banks do a better job of that than Silicon Valley Bank. And the Fed's put this facility in which says you can post collateral and borrow against the par value of it. I mean, that's basically filling that whole void. I feel like they've done a lot here that should shore this thing up. I'm surprised the market's as fragile as it is, to be honest. It's very strange. They move quickly in some significant ways.
Yeah, I didn't mention this, but I think one of the big things they did to stabilize the global system is the swap lines that were created. And people don't really focus on that, but you are going to run into a dollar shortage, and that would have really crippled the system, I think, if they didn't do that as quickly as they did. And they've learned a lot from the last time, but we also don't learn a lot from previous problems too. Andrew, I think you were up next. Yeah.
Yeah, sure. Hey, thank you again. This is always awesome. I'm happy to be here. On the bank front, that $2 trillion of uninsured deposits that come in requires approximately $200 billion of equity to support. And they had that $200 billion of equity as the markets were going up, right? And when their stock prices got crushed over the last 6 months, that equity disappeared. And so they were over levered. A lot of people look, there's a great, I call it great because it's size, article in Barron's about why you should buy the big banks that just came out and clients have been sending to me. And it's important to recognize that banks, they're saying banks are so cheap on a PE basis, but they're also levered 8 or 9 times. We forget about the leverage. We think that 11% tier 1 capital is some magical cushion that's going to save you in a crisis. And in fact, they're levered 8 or 9 times their shareholder equity. And at the same time, their shareholder equity, according to consensus, is going to grow 0 over the next 3 years. They expect, consensus estimates expect 0 shareholder equity growth among the 6 largest banks in America. So you've got 8 or 9 times levered balance sheets with no growth, over-regulated, and they're not marking to market on their long-term assets. So go figure.
And I suspect the new regulations are going to be very as damaging as the old ones were because they solve a previous problem, not the next problem. And then they don't fully anticipate if you make some banks systematically important and then stop it at a set number, the others can be just as important over time. And I think the community banks provide 31% of the loans to the United States. So
no, you're absolutely right.
There's a big problem coming.
The local business lending is done by the community banks without a doubt, double or triple the rate of the big banks.
And that's the vulnerability that they're worried about.
These
I think
$2 trillion
part of the problem here. Sorry, go
by
ahead.
Fed policy. So you've got, all of this ended up on the balance sheet of the Fed Reserve. If anybody can fix it, it's the Fed.
They can get enough on, they can hold it to maturity.
Let's get a few more people in. Adam?
Yeah, Stephen, what else with all this money that the banks have and they're getting into a position where they're reluctant to lend, what else can they do with the money? They have to invest it somewhere. Yeah, that's one question. The other question is, and I guess this is the billion-dollar question, how prevalent is the mismatch, in your opinion, between liabilities and assets out there in the with these banks?
It's almost unknowable. To be blunt about it, I don't know any other way to say it. You'd have to go into every bank, look at and try and figure out how to match them up, and then risk assess it for different future events. And I think what they missed was how fast the speed and magnitude of the rate move, I don't think would be in many value at risk models as a high probability. And I think people just took advantage of that. So I think it's unknowable right now. Makes it difficult to answer. Back to Chris's original question, in the bank area, it's very difficult to have any confidence right now.
But
And that's-
here's the
puts the banks in a
thing,
very
the
difficult
essence of
situation.
banking is this mismatch in maturities. This is the essence of how you make money with a bank.
Yeah.
Exactly.
It's huge. Now, don't forget, you can hedge this though.
Yep.
People do hedge it. Silicon Valley Bank didn't hedge it, but they could have. at a cost of probably half the margin on the securities they bought or something, or a third or whatever, but.
Would have been a little less than they lost in the value of the bank.
Yeah, less, exactly. Instead they chose to run an existential risk, which, is really incomprehensible to me.
Well, the interesting thing too is the Fed told them what their playbook was going to be, and Powell, for all the criticisms you can give him, it's not like he didn't say they were going to fight inflation and raise interest rates pretty aggressively throughout the last 12 months. I don't think the market wanted to believe it, but he was pretty clear on it. So he didn't actually mislead anybody in how they were going down that path. The banks just chose to see what they wanted to see for the outlook.
So Michael, since you already asked a question, I'm going to let Rob ask away and come back to you.
Hey, guys, thanks. Steve, my question's on the sort of the other side of the system here, meaning the company side. I think we've all received a lot of invites as to reactions to SVB and Signature, et cetera. Are you, or Mark, you might even have some input on this. Are you seeing correction by the companies as far as, and some of the biggest advice there was don't put all your money in one bank, use better cash management and other type things. But I was curious from the raw startup side and the growth company side, what are the key takeaways, and are they actually incorporating that into sort of ongoing operating discipline?
This is a little anecdotal, but John Najarian, he'll be with us tomorrow,
Yep.
the next day, and he was interviewing Mr. Wonderful on his show, who said he has as a policy that all the portfolio companies put max 20% into any one banking institution, and all those CFOs and CEOs are under orders. You have 24, 48 hours, and who's the beneficiary? Often it's the big banks. Once again. Anyway, it's a little anecdotal, but other people have probably more nuance.
There's every reason to split your deposits up, even if you're not concerned about the health of the particular bank. What if your bank gets hacked and tomorrow you can't get to your money? I mean, a prudent person would diversify their deposit relationships, period.
Yeah, the relationships, period. Yeah, and they're often putting all their money into Goldman, thinking they're going to get loans from Goldman. But they should be with BAML and ARS.
Well, Silicon Valley went for every nickel that everyone had, every loan they had, it's business, it's personal, it's your house, it's whatever. They were going for everything. And they were doing it in one industry that was going parabolic.
So, Michael?
Okay, Stephen, during your presentation, you talked about quantitative tightening.
Mhm.
We've been doing a lot of talking about uninsured deposits. If the Fed is guaranteeing those uninsured deposits, taking bonds at par is collateral, whatever, isn't that kind of a backdoor QE?
Yes. What's there was, in a sense, it's not technically, I don't think technically the way they're doing this is a reversal of QT, but it has the same effect. The balance sheet, I think, is going to change by about $200 billion right off the bat, or $300 billion already, depending on what lines people drew on. So yes, there is a reversal of QT going, and I think that's one of the things to listen for in the press conference tomorrow from Powell. Is what do they do with QT? Because it's the one thing that people didn't really focus on as much, but it did. I think it clearly had a bigger impact in the San Francisco Fed, which I've shown you their proxy yield showed it was basically 3/4 of a point higher interest rates than the actual Fed funds rate effectively. So I think you're right. I think that switch is going to be something to see, because you could be going back into QE again with this. Kiresh?
I want to add to the last question that mentioned that at the end that what if the bank gets hacked and all that stuff. So as a PR professional from the PR crisis standpoint, I want to add that first thing that a bank would want to do is they want to minimize their losses and make sure they let the customers, the stakeholders, and the investors know that if you try to if they have their investment in the bank, they don't have to worry about anything because they're going to be fine. They have to you have to make sure they're not frenzy and they're going all over the place in town and trying to pull out their money and everything. Second thing is they're trying to recover some funds. So there's like a couple strategy they could do throughout this point to make sure this hack gets prevented and doesn't happen again in the future. So a bank getting hacked is a big deal, but they'll try to prevent it as much as they can.
But we have to keep in mind that our banking system is fully built on trust. The assets don't go anywhere near the liabilities that they have.
Our whole monetary system.
Yeah, the whole monetary system is based on that. So it really is, this is one of the more interesting times that of many that we've had over the last 15 years, but this is one where at least in 2008, you had a path that was clear of what you could do. A lot of people didn't like it, but it was what you could do, which was lower rates to zero or negative and do QE. We never really had a plan for how you get out of that after you're in. And the question is going to be, with all the debt in the system and the low growth rates, and now you have these crises on top of crises on top of crises, do you have to then just continue to monetize the debt?
But I have to say something about the fintech part. The banks are a little bit more sophisticated than not as sophisticated as the government, but they're as sophisticated as they can be. But the fintech, such as Venmo or Cash App and Apple Pay, they could be a little bit more vulnerable, but they're all the other ones have risk at the same time too.
And on top of it, I'm a crypto skeptic, as many of you know. Now I got to hear it for the last week. Everyone's making money hand over fist, but I still think it's a short trade.
I've never bought crypto. I've not been a huge fan of it because it's outside the system. But I do think what I mentioned in one of the briefings last summer when the Bank of International Settlements is looking at how you bring crypto into the system. I think their game plan for how you bring it in with central banks at the base and then using it for the right applications throughout the global economy, it can work, but I think it has to be brought into a regulatory umbrella, which is the argument you're going to get right now is the reason we shouldn't be brought in is because of all the mess that you're creating right now. But, how do you regulate an unregulated system and a regulated system? How do they coexist? Very hard to manage the economy that way. So I think it's a really interesting setup that will bring the two closer together, which is going to be fascinating to see.
I still don't know how you value that. MJ.
Yeah, hi. Couple of things, I think that now and just, and now more than ever, leaning into the whole transparency of this thing is incredibly important. We would have been affected by Silicon Bank. We had a bunch of money that was being held. We needed to work very carefully and ask what was going on with the company that was holding our funds in escrow. Funds that are going out, we're connected to Silicon Valley Bank. And so I think that it's really important at this point that, less regulatory and more like making it mandatory for for people to be transparent and companies to be transparent. Everybody knows I use Angel Span as a very, and I don't stick sunshine up anyone's ass, but it's pardon my French, but it was a really important, nice to have. Now it's really a must have. People need to know what's going on at all times. With me, I need to know what's going on with other companies. And so we need to start leaning into the conversation for people to do this as a rule rather than an exception.
Speaking of Angel Span, we'll have Joe tomorrow. He's everywhere.
It's a very nervous time, very, very nervous time. And we just need to always be transparent with what's going on all sides. I was nervous to send a wire out this morning because I had Silicon Valley Bank information that was, being sent out. I had to edit it, but I had to look at it 52 times. So it's a real nervous time. Everybody needs to get very transparent with what they're doing.
By the way, MJ, you should meet Mona, but you're in Florida. Mona is the second on the last panel on health tech. She, music, as you've talked about mental health, could be a positive factor.
Yeah, we did that deep dive with Recovery Rocks on the power of music connected to treatment. So yeah, I love it. Love to have that discussion. It's very important.
Kate?
So, a couple of questions. One is, we were also impacted by SVB, and we still have all of our money with SVB because our thinking is that lightning doesn't strike twice, and it's the safest place to be. But the other bank that we've onboarded with is First Republic. So my question is, how do you evaluate the health of a bank like First Republic right now? And the second question, maybe more of a comment, Mark, you said you don't trust crypto right now, and it sounds like the folks here don't trust banks. So if you don't trust crypto and you don't trust banks, who do you trust?
No, I hear you. Well, I guess we're trusting in Uncle Sam in some respects. But is that a question? Your original question, though, was about First Republic. You had to get a dig on me because you're, but it's okay. First Republic, comments?
Yep.
Yeah, I'm not sure. I'm not sure what happens to First Republic right now. There's not enough money to go around to bail all these guys out. So I think what Credit Suisse, what the ECB and Swiss National Bank said with Credit Suisse is banks are going to go under. That the equity and bondholders are probably going to get wiped out and the depositors will be okay. But I suspect if they ever try and move to ensure more deposits, I don't think they can ever go 100%. I think they would only give you certain coverage, not 100% coverage. I think they just will keep pushing up the limits and do it for a limited time. It took 2 years after the financial crisis for them to codify the raise to 250,000 to pass that legally. So I think we'll be in this period where they're going to try and stabilize things and then hope they don't have to do anything else. But I think if they do, it'll take some time before they can make a guarantee like that.
Henry?
Yeah, so quick follow-up, Stephen. So if you recall 15 years ago when we had the GFC, it was a liquidity issue, confidence issue, but the balance sheets were a little bit different, right? So a lot of these banks that went under had really toxic balance sheets, right? So the CDOs, MBS, all these happened. But do you recall one of the last cycles, not the last cycle, one of the cycles in the past when the Fed was tightening, that you had banks had sort of assets and liabilities mismatch, right? Do you recall? I just don't recall. I just want to see whether you recall. Anybody recalls a similar incident such as such? What was the playbook then? Do you recall anyone, or in Steve or whoever?
Continental was in early '80s, so different kind of a playbook for that one.
The playbook here is like the 1980s banking and S&L crisis. That's what this looks like. Much more than 2008.
Yeah, receiverships and the like is what you're thinking, Chris?
Yeah.
Well, wasn't there also sort of a lending cartel to the energy industry at that time, Chris? Maybe you remember. I mean, you kind of had an insider game. I mean, I think I remember I was working in New York at Manufacturers Hanover, and we wanted to get into the oil lending business, and that was no easier than it was to, compete with Silicon Valley Bank with the sort of clubby nature of the venture business. I think
For
there's
sure, there was, if you like, a club element to oil and gas lending then, and I guess you got to be careful what you ask for, right? If you didn't get into the club, you were better off. So
Yeah, and so the market's sitting there extrapolating as Silicon Valley Bank to like every bank in the country right now. I mean, I don't know. It doesn't make sense to me. I think, Stephen, I mean, seriously, you think the Fed's going to come out, Powell's going to come out. They have to fix this banking confidence thing. I mean, that has to be everybody's priority right now. How can they worry about inflation that's already coming down when they've got a banking confidence crisis? I mean, I don't see how there's anything but problem number one to be addressed here. By the Fed, by the secretary, by Janet Yellen. I mean, yeah,
I think, Duncan, you're right. You're right on all counts, except that I think it's not all on the Fed. It really is on the Treasury as well and on Congress to kind of give some sense of confidence. And Congress isn't doing it when they're ripping the oversight and politicizing this instead of dealing with the problem. That's an aside. But I think that they are going to, I think the Fed's got to fight inflation still. I mean, if the prices keep going up on everything, we have a big issue with that too, Duncan. I don't think they can. I think they're going to say that they're dealing with the stability by the actions they're taking with the banks and whatever they do to ensure deposits, whether that changes. I don't think that's going to be a quick fix. So I think they're going to try and stabilize the system the way they're doing it now and then go from there. So I think they have to still fight inflation. It is coming down, but there are areas where it's really sticky still. And you're seeing it with some of the increase. You have the teachers in LA right now on strike. They're looking for a 30% increase. I think I saw the average starting salary was like 25 grand for a teacher in LA. How do you live on that? So I think we have some real issues that they're going to have to battle through, and there's no easy fix. And for us, this means with as slow a growth rate as we expect we'll have, with the rate of growth of debt that continues, I think you're going to be in a mode where the Fed's going to continue to monetize the debt.
Hey, Steve, it's Rob. Just to Henry's question and Kate's observation on First Republic, the consortium that came in there rather publicly, like JP Morgan and Wells, these big banks, in terms of their infusion or protection, is it the read here that you feel that was, some of them have done that reluctantly, or it seems like they're also pounding their chest to gain market share, to gain customer traction and other things?
It's interesting. I think what JP Morgan put in like $5 billion, and so did BofA. I think they each took in like $16 billion in deposits. Yep. So out of the goodness of their heart, they're helping out the banking system. Listen, I think Jamie Dimon took the lead, called up people and said, we got to work to fix this. We got to try and stabilize it. They thought it would be enough. It's not, and they're going to continue to work through it. I think all the big banks know that the confidence problem doesn't end if the small and mid-sized banks go away. I think they believe it continues until for the next weaker bank, unless people get confidence back in the system. So I think that's the fight, and I think that's what they're going to continue to fight.
Is anybody else bothered by the accounting here? I mean, I think this leaving the held to maturity assets at acquisition cost is a mistake. I think it facilitates stupidity.
It's going to be debated. I don't know that in and of itself is the problem, or it's how weighted they were.
It's not fundamental to the problem. It's just a little piece around the edges that I kind of don't like. It has a tendency to mislead the lazy or the foolish who don't read all the disclosure.
Exactly.
I agree with that, Chris. I think one of the challenges in the system is you're touching on, but I think the issue is that we don't know how to effectively regulate these guys. And when we try and regulate them, we misregulate them. And it's the attempt to solve problems that create problems, because then they're half-assed solutions and usually politicized solutions instead of practical ones that actually do control risk. And so I don't know that the change from hold to maturity for part of their portfolio is really the issue, because they're supposed to have long duration assets because they're dealing with long duration loans. So there is an element there. It's this one, I think, is a timing and a judgment issue by this bank. I don't think it's really the hold to maturity in and of itself. But the Fed should have warned when they were raising rates as fast as they were. I think that was the signal for people to say, we got to look at this differently. And it might have been too late. I don't know.
So we have 3 more minutes. Michael, you're back for your third question.
I'm just inquisitive.
Yes.
Stephen, what you just said makes me wonder. When you talk about not regulating and then misregulating, which is worse?
I don't think one's worse than the other. It just depends. It depends on what the crisis is and the cause of the crisis, but it could be either one. I think the issue is in that, and we're in one of the most highly regulated businesses in the world. And we're going to get more regulations coming our way very quickly that are going to increase our costs considerably. But most of them, a lot of them make sense. I would say most of the rules that we have to follow make tremendous amount of sense. Some of the stuff that the regulators come up with makes none, and that's fine. But I do think we're in a period where getting it right is it takes more time than I think the attention span of Congress or the committees want to spend. And it doesn't get them the brownie points that they're looking for with voters. And I think that's really where the problem lies.
One more question then, Paul. Looking at you makes me think of Credit Suisse, of course.
Yes, the Credit Suisse alumni were having.
Well, look, I was at Arthur Andersen, so we took our.
We're planning the reunion soon, but I wanted this is actually going back to my when I started at Credit Suisse, 1994. It was a similar rate environment in the sense of how fast rates went up. So, but I just wanted to ask Stephen, like, what happened then with banks? Because I remember broker dealers having a lot of issues, like Kidder, Solomon, First Boston. You know, there was a lot of blowups at the BDs, but I don't remember banks like commercial banks having huge issues with the rate increases.
That's because about 4 years prior, or 5 years prior, you had the savings and loan crisis, you had the loan to developing country crisis, and they all had to pull in their oars to not take the risk. And Mellon Bank came out with the good bank, bad bank, and they threw all their bad debts into the bad bank. So I think they were in a different, less aggressive mode. Even though it was a relatively good economy at that time, they were taking more reasonable risks because of the problems that they were just getting out of.
Got it. But the industry has the most capital of ever in terms of the amount of capital it has. Is this going to be that it needs to be an industry solution, that it's going to be the large banks depositing, like similar to the First Republic plan, where you have large banks making deposits to these smaller banks just to kind of spread it out? And maybe that's something that the Treasury, the Fed, the FDIC, they kind of, push it, that it's got to be an industry kind of solution.
They're going to put the deposit insurance is going to go way up on these guys. And I think the cost of regulation is going to really put some strain on the smaller banks anyway. And then you have the issue of regulatorily, how can they consolidate when they were just told that they can't consolidate. So I agree with Michael Hammer's comment in the chat that he just put in. It does create a lot of other issues, but I think they're going to come together and it's going to make it an industry problem solved with higher costs for them.
Thanks.
And that puts, I think, some of them completely out of business. And you could see a run of consolidation going on to try and get big enough to deal with your increased regulatory costs.